They wanted, when I say they, I'm talking about the administration, the Trump administration wanted to onshore gold because I think it's their plan at some point to revalue gold. Once they revalue it higher, then all of a sudden you're going to get, gold as collateral to be borrowed against.
To break above this upper level line, I think that will happen actually fairly. If it does occur, I believe it could occur over the next 2 to 3 weeks. But to go to the levels I have spoken about, that I am not looking at as something even towards the end of the year, maybe first quarter of 2026, to hit the target of 37 to 3,800. A hard break below this lower level, what I labeled as a support line, which is currently at around, call it 3350. If that happens, you're looking at your next technical level as low as 3200, and below that, which I don't believe it would get to that easily, but that would be at around 31 to 3,000 to 3,100.
The debate over America's monetary future is intensifying, with signals pointing toward both gold revaluation and renewed interest rate cuts. Recent analysis highlights how efforts were made under the Trump administration to onshore gold reserves, ensuring that collateral is physically within U.S. borders before any potential revaluation. The logic is straightforward. Once gold is revalued higher, it becomes a far more powerful asset base, one that could support borrowing and collateralized lending in the next phase of the financial cycle. This isn't about paper promises, it's about real, tangible wealth. BillHolter and Gary Wagner point out that Washington may finally be acknowledging that paper contracts can't create supply. Real mining, drilling, and production are what underpin an economy's strength. By cutting red tape, particularly in the resource and mining sectors, the government may be preparing for a future where gold plays a more central role in monetary stability. Yet the other side of the story lies with the Federal Reserve. With inflation still unresolved, the push for September rate cuts highlights a dangerous contradiction, attempting to stimulate while still fighting price pressures. That tension will shape markets for months to come. If you found this analysis insightful, don't forget to like this video, subscribe to the channel, and share your thoughts below.
It seems to me like somebody's waking up in Washington to understand that you can't create supply by creating paper contracts. They understand, you got to dig for minerals, you got to drill for oil. I mean, it's a physical anomaly, if you will. I mean, it's not something that they can create with paper. It's good that somebody in Washington is realizing that. I mean, they did that with other rare earth minerals. I mean, there's all kinds of things that the United States needs to really get to work on and should have been on to work on 5-10 years ago with the way that our supply chains are. I mean, we rely on enemies for things that we need to make war. And that's a ridiculous supply chain. They wanted, when I say they, I'm talking about the administration, the Trump administration wanted to onshore gold because I think it's their plan at some point to revalue gold. And it's obviously much better if you have it on your shore or in your control as opposed to overseas. I view it as what they did was they onshored unencumbered collateral because there's so little collateral left anywhere in the world to borrow against. And if they're going to revalue gold, they want it onshore so that collateral gets revalued higher here. When I say here, where they have control over it, where they can use it, whatever, where they can lend it, I mean, obviously once they revalue it higher, then all of a sudden you're going to get gold as collateral to be borrowed against. So maybe that's their plan for the next inflate or die cycle.
Do you think there could be any connection to, we heard Fort Knox audit, and then they've gone awfully quiet on that since? I mean, obviously we're guessing here, but do you think Trump found an answer he wasn't expecting, or what? Anything you've heard on that?
That I've not heard anything, but that would be my guess, is that he heard something he was not expecting. Don't do the audit because you won't like the results. If you have an administration that's friendly to an industry, it makes working or competing in that industry easier because you've got a government that favors it and is cutting as much red tape as possible. And that is one thing about Trump as a businessman is he understands. You don't look at the price of something because the price can be painted, can be manipulated, can be altered using leverage, using derivatives. But getting it out of the ground, he understands the permitting process, if you will, with all the buildings that he's put up. So I think he understands that the permitting process is huge. One thing he's certainly not followed up on. Look what's going on in California. I mean, what is there? 5 houses now total that are under construction from the quote wildfires. I mean, talk about red tape.
Yeah.
You only got 5 houses out of thousands. What was it, 13, 14,000 houses? I forget what the number was, but you only have 5 of them that are able to rebuild already because of the red tape. And that's what they're doing, I think, with the mining industry, is cutting the red tape, making it easier to get product or projects started and moving along.
Cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance.
Earlier in the clip, he mentioned how we're 4 years into being well in excess of the Fed's mandate, and how is he going to solve this? By cutting interest rates. And I'll pull up the futures curve, but it looks, I'm hearing a lot about 50 versus 25. So which part of the math am I missing there, Bill?
Well, you're exactly right. If he's talking about cutting rates, but inflation could be a problem, I mean, it's what the market's already told them a year ago when market rates went higher and after they cut interest rates. I suspect that's going to happen again. I think we're going to have a weak bond market in this cutting cycle, and it's math. I mean, if I was there, if I was a journalist asking questions, I mean, there's so many questions you could ask him. The biggest one of all is, isn't inflation a result of monetary policy?
I don't think he believes that, or at least
inflation is a monetary event. Now, one thing he said was a one-time price increase. The only 2 things that could come to mind would be all of a sudden stuff costs more because of tariffs, or is he talking about a reset? Is that what he's talking about? I don't really follow what he's talking about, a one-time.
Powell said that he believes that there's some uncertainty as to what the tariffs will do, but it is nothing that their ability to hedge that by cutting rates and boosting the economy back up won't have an impact on. So for that reason, I think that we will get a interest rate cut of 0.25% in September. Will we get another cut this year? That is really uncertain. I believe we'll absolutely have one in September, and the question is whether or not there'll be 2. But remember, he's trying to bring it down to a certain level that would require additional rate cuts, not just one 25 basis point rate cut in September. I think that once we get the rate cut that many economists are anticipating in September, that will be a relief, because then it will signal that the Fed is back on the path to interest rate normalization, meaning they'll have a series of rate cuts this year as well as next year and bring it to an acceptable level as long as inflation doesn't spiral.
Gold's price action is entering one of its most intriguing technical phases in years. After a long sequence of rallies and shallow pullbacks, the market has now formed what looks like a symmetrical triangle, a pattern defined by descending resistance and rising support. Unlike a typical deep ABC correction, this compression has held within tighter ranges, signaling pent-up energy. The technical implication is straightforward. Once the breakout occurs, it tends to release momentum sharply, and in this case, the bias remains higher, given the prevailing uptrend that has been in place since 2023. Recent moves from $2,000 to over $3,500 reinforce that bullish trajectory, and with consolidation holding above key supports, the probability leans toward a push above resistance. Targets suggest $3,725 and potentially beyond if momentum carries. Safe haven demand, combined with uncertainty around central bank policy, continues to make gold the preferred asset of stability. Let's get back to the interview.
What you'll see is we've got the same gold chart, but I'm looking at it a little bit different. You should have it up on screen. So we've had a series of very, very long rallies, very, very shallow corrections in terms of what we call our Elliott wave count. And let me go ahead and just put that in. We've had our wave 1, 2, 3, 4, and 5. And that takes us to August 22nd, when we hit the all-time record high, and we had an exaggerated intraday high. But from there, in essence, we developed what I'm labeling as a symmetrical triangle. In other words, even though we've had a couple of equal tops up here, if you draw your trend line on this triangle from the intraday high that came out on the 22nd of April, you definitely can make a case for a descending upper level resistance and an ascending lower level support. And what that means is that we've entered a major correction, but rather than it being a standard deep correction, what we would call an A, B, C correction, and then move back to a motive phase. Because my belief right now is obviously we're witnessing one of the most bullish times in history. And we've had a multi-month consolidation after hitting this high here. And so I believe that we are at a point right now where we could in fact see a breakout above this upper level resistance line, and that would take it substantially higher. In terms of where I think it could go, all I've done is converted that regular chart into a line chart. But I believe that we could see gold go as high or higher than 37.25 if, in fact, we get a break, which is called a basic thrust. If we get gold to break above this particular resistance that's there, which I've detailed here. So whereas we're witnessing consolidation, it's not really a standard consolidation. We've had a series of lower highs, a series of higher lows, and I believe that we could see gold break out from its current area, because you can see that once it hit the bottom of the channel, it's been moving back up over the last week, and now we're actually very, very close to 34.72, which is my first target. Once that breakout happens, I believe energy will be released. Any kind of a pattern that is a compression pattern, when it breaks through resistance, it does so with a fever. And if I'm correct, we will see this market move much higher. As I said, in terms of where I believe we could see it go, above 3,700 is what I'm looking at right here. You're 100% correct in that when you have a symmetrical triangle that reaches the apex, it doesn't necessitate that it breaks above the resistance line or below the support line. The reason I believe that the probability of a break above this resistance line is pretty simple. It's based on the fact that we've had a series of equal tops. Every time we came back down, it would go back up and hit this channel. But if we look at the overall trend, the prevalent trend, we have to acknowledge that that trend has been an uptrend. And that's what, if we look at the fact that gold in October 2023 was at 2,000 and it's risen tremendously to above 3,500, excuse me, this one I had wrong. It went from 2,000 to 3,500. The prevalent trend direction has been up. And that is why I believe that all things being equal, in other words, if the fundamentals that were at play are still in play in the market, the likelihood is that after this consolidation, that gold will return to its prevalent trend direction, the direction it's been moving towards, all things being equal. And we have to acknowledge the trend has been dramatically higher. We have to acknowledge things changed in April on the 17th, where we started to get, rather than a new high, correction, new high, correction, we got a series of almost a flat top, but it is still a descending resistance line and ascending support line. And I believe the breakout to the upside is based on the fact that all things being equal, the trend after the consolidation is over will return to its prevalent trend direction preceding it. And that's the reason I believe that the probability favors a breakout to the upside. Now, what would change that? If the fundamentals that were in play that took gold dramatically higher are no longer in play, then of course, we would look for the possibility of it breaking to the downside. It's not parabolic as it was if you look back on April 7th and this move up here, the correction in this move. This is a straight parabolic move. We've had it consolidate. Does it worry me that it continues to make new highs? I would have to say it amazes me, it astounds me, but I'm not troubled with it in terms of it matching the uncertainty factor that traditionally moves gold higher. People flock to a safe haven asset for exactly the reason of the definition of safe haven. It's a level of safety when there's uncertainty. And we certainly have a lot of uncertainty right now in terms of what's going to happen with the Fed, the recent addition in which he apparently fired Governor Lisa Cook, but she's going to fight it. Does he have the right to? If he does, was it really with cause? And now they're both saying, well, we'll let the courts decide. That certainly ratchets up the uncertainty factor, because it's not knowing the outcome that will move traders to a safe haven asset. Your bet isn't on the dollar. And this dollar weakness has also been part and parcel to what's moved gold substantially higher. I don't see there being an alternative to gold as a safe haven play for safety, in as much as you could look at silver, you could look at platinum or even palladium. But I think that that's probably where we got the push in silver, as we saw it play catch up after gold hit really a series of tops where we didn't see it making all-time intraday highs, but rather a series of lower highs and a series of higher lows. And that's why I've labeled this correction as a symmetrical triangle, compression triangle correction. In terms of breaking above it, I think that will happen. If it happens, it's going to happen in the next 30 days. But realize we're very, very close to that target right now. I'll convert it back into a candlestick. We're very, very close to the top of this channel right now. As it is, I believe a breakout will move it substantially higher. The one thing that the techniques I use, which is trend analysis, pattern identification, The one thing it does not account for effectively is the element of time. To break above this upper level line, I think that will happen actually fairly. If it does occur, I believe it could occur over the next 2 to 3 weeks. But to go to the levels I have spoken about, that I am not looking at as something even towards the end of the year, maybe first quarter of 2026, to hit the target of 37 to 3,800.
What is the floor or bearish level that it would need to break beyond which you would say to yourself, this is definitely a new bear market and we should be worried?
A hard break below this lower level, what I labeled as a support line, which is currently at around, call it 3350. If that happens, you're looking at your next technical level as low as 3,200, and below that, which I don't believe it would get to that easily, but that would be at around 3,000 to 3,100. What we see, this is a very long-term monthly chart, and the area that we couldn't take out was $33 and above, and obviously that got taken out at the end of last year, the beginning of this year. And now if we look back at where current pricing is at about 38, we need to really go back to 2012 to see the last time silver had a value of $42. And for $38, we need to go back to March of 2013. So silver has not been performing in any way in the same that gold has, but it's never been considered to be the kind of a safe haven play as much as gold has.
Gold's consolidation phase has created a powerful setup that could soon resolve into one of the most decisive moves in recent years. The symmetrical triangle that has formed since last April reflects the market's underlying tension. Higher lows meeting lower highs, building pressure that almost always leads to a breakout. While the direction of any breakout is never guaranteed, the broader context matters. Over the past 2 years, gold has surged from $2,000 to over $3,500, proving that its prevailing trend is unquestionably higher. This compression, then, is not a sign of weakness, but of energy being stored. If resistance is breached near $3,472, momentum could carry the market toward $3,725 and beyond, with longer-term potential pointing to the $3,800 zone. On the other hand, support rests around $3,350, with risks being lower only if the fundamentals shift dramatically. For investors, the conclusion is clear. Gold remains the premier safe haven asset in an environment of central bank uncertainty, debt stress, and geopolitical instability. The lessons of past cycles remind us that when financial systems wobble, capital seeks safety, and history shows that safety most often lies in gold. If you found this breakdown valuable, don't forget to like this video, subscribe to the channel, and share your thoughts in the comments below.